he gets to pump the energy up, I get to bring it back down. But no, I'm kidding. I'm very excited to get to be here. Really grateful for everyone who made the trip, everyone who's out there on the digital version of this. Just welcome. For those of you I haven't had the chance to meet, I'm Paul Leandris. I'm Procore CFO. I'm really excited to talk about what this journey, that last slide we just shared, has been like over the last few years. For those who don't know, I joined this business about 8 years ago, and I had the privilege of having a seat on the bus as we went through this massive transformation. And it was expensive, it was difficult, and I will tell you that it has been transformational for who we are. I'm going to spend today talking through this journey, each of these different vectors that we've gone through from becoming a single a single solution, serving a single stakeholder in the mid-market in the US, to a global platform with multiple stakeholders and multiple segments. I'm going to start our journey with the product and technology evolution. The comprehension of that workflow, our huge was not where this business began. When I joined, we were a project management solution. We had one product, and we were doing quite well selling it to the mid-market. However, we knew that we would never meet our mission and vision. We could not connect everyone on this global platform if we didn't go out and build more and more solutions that brought these workflows together and helped solve these problems. So what you'll see here is 2015, 2016, we started building solutions around the edges of project management, inspections, a budget tool. But it wasn't until 2017 that we launched quality and safety and project financials. And remember those names, because as I dive into our actual ARR by product, one of the things I've told you all many times is that the longer a product's been in market, the more penetration we've seen with it. But this product evolution was not easy, and as I said, it did not come without quite a bit of investment. I challenge you all to find another construction technology company that has spent $500+ million on R&D since 2017 alone. That doesn't count the acquisitions. I think you could probably find some construction companies that have done 8 acquisitions. But the reality for us has been that every acquisition, everything we've done, is about bringing these solutions together on a single platform, a connected ecosystem that talks to one another, that helps these customers actually solve their problems. But what I want you to see on the left side here is that we're nowhere near done. And I think a lot of you would be surprised to find out that while we're still investing heavily in project management, that's actually not where the bulk of our dollars are going today. What this chart is meant to represent is a reflection of directionally, where are we putting our R&D dollars today? And what you'll see is pre-construction, financial management, these bookends of that workflow are huge investment areas for us, and something that we think are going to continue to make meaningful strides both in terms of functionality, but also in terms of adoption. And of course, we couldn't sit here and tell you we are this connected platform that brings people together, that is flexible, that is able to truly provide data insights without putting our money where our mouth is. And you can see that the Procore platform is a huge area of investment for us. And what's so great is that while we're only in the super early days of this, we're already seeing the results. As I told you before, financial management, quality and safety, first 2 products, they make up 30+% of our ARR today. Project management, just over half. And what's even more exciting is that these newer products, this 17%, these are very new products. These are things that are really in the early stage. They've taken a lot of work, a lot of investment, but we're seeing the growth. And the reality is, the thing is, project management isn't slowing down. It's not like our market opportunity there is any less great than it's been. But this additional products, the things we've built for our customers, is truly showing that we listen and we solve their problems. And despite this, we're already seeing, despite the fact these are new, despite the fact that many of these newer products still make up a small share of our ARR, we are seeing traction. So today, 44% of our customers use 4 or more products. Keep in mind, when I joined 8 years ago, we didn't even have 4 products. Now, 70% of the ARR comes from those customers. What I think is so exciting for us is that this proves our customers want what we build. They are out there and they are buying, they are adopting what we sell. But it's still early days. So we tried to figure out what's the best way to quantify this market potential just within the install base. So again, this 50%, no additional volume, no new logos, no new countries. This is about saying, if I can take my customers who own 1 to 5 products and bring them up to the price point that my customers who have 6+, and keep in mind, 6+ is closer to 6, 7, 8. We have customers that are greater than that, but directionally, this is saying, if I can take the customers in the 1 to 5 category to what I've already proven. I don't have to tell you guys that these are things on the come, that people haven't bought or used, that people aren't paying for today. If I can get them there, I have 50+% potential just in my install base. And we think this is quite conservative. And as I said, it doesn't include new customers, new logos, new products, changes to pricing. This is just what we have today. But not only have we had this massive product expansion, but we also believe we're in the early days. When we think about the GC, this is just one of the stakeholders we serve today. Similarly to the conversation around the product evolution, we've done a lot of work. Blood, sweat, tears, my hair. These things all came with the launch of multiple stakeholders. And you can see here, similar to products 2018, 2019, this is when we really made that foray into multiple stakeholders. But you have to understand that foray didn't happen overnight. The idea of building a brand, a team, a dedicated go-to-market, it took time. And not only did that take time, it took time to get the right products to the right stakeholders. So what I really want you to take from this chart is that project management, the thing we started selling to subcontractors and owners when we launched these markets, it's actually not their biggest pain. It's certainly one of their biggest pains. And the fact that they bought it from us when we couldn't solve their biggest pain is a testament to how valuable project management truly is. But what you'll see here is the work we've gone through in the last handful of years and why we believe that today we can solve each of these stakeholders' biggest problems and we can have really great conversations that we've never been able to have before. And it's why that journey of building the go-to-market, which I'll talk about here in a moment, is not enough. Making sure that you can weave together the right workflows, the right solutions, that has been a big part of this investment in our stakeholders. But of course, the go-to-market matters too. And I think one of the things that isn't always clear when we talk about our business is that we've built dedicated go-to-market motions here. We're talking about marketing, customer success, obviously product, sales. These are folks who are tailored to go after these different stakeholders because the conversation you have with them, how you relate, the language they use is different. They might be building on the same project, but their perspective is not the same, and their biggest problems that they just talked about are not the same. What you should expect over time is that these will continue to converge to being closer to a third, because as we'll talk about a little bit later, the market opportunity across these stakeholders is massive. Each of them is almost the same size and has so much potential left ahead of it. And we're already seeing the return. Today, I've talked about GCs, half to two-thirds, directionally 60%. What I think might surprise some of you is actually the size of the owner's business. And part of the reason that the owner's business is so strong is if you go back to that chart I just showed in the hierarchy of problems, we got to the owner's biggest problems first. And we were able to build great credibility with some massive names. Fortune 100, cities, states, you name it, these are these customers. Subcontractors, just getting started for us. We'll have Will up later to talk about why subcontractors are such a valuable stakeholder for us. But we believe now that we have workforce management, estimating, some of these other offerings, that subcontractors are going to continue to take off, and we're so excited about that opportunity. When we think about the logos, challenge in construction is, I imagine many of you all don't keep track of the best general contractors out there, the best specialty contractors out there. I don't blame you. You probably don't go to sleep thinking about Skanska like I do. You probably sleep better than I do. But what's important to take from this is these logos, they represent some of the best builders out there from small to big, whether it's commercial, whether it's civil, infrastructure, hospitals, schools, you name it, these are the people who build it. When you think about the specialty contractors, what's important to understand is this isn't just a type of specialty contractor. This is concrete, this is mechanical, this is electrical. This is everything it takes to get a job done. Now, the owners, hopefully some of these names make more sense. But what I want you to see on that list, there's not a lot of real estate developers. It's not that we don't sell to real estate developers. But when we go back to that 22%, when we talk about that market opportunity, folks like Starbucks building retail buildings, Boston Children building hospitals, Tyson Foods building processing plants for chickens. These are the assets that these companies have to have in order to run their own business. Those are the owners that we have tremendous traction with, and again, are just getting started. Similar to the go-to-market motion when we talked about stakeholders, segment's another area that we spent a lot of time and energy building out dedicated motions, ensuring that we are able to have the right communication, the right talk track. And so today, what you'll see is where we started in the mid-market, that 20 to 100 million, that now represents just about 40% of our overall go-to-market motion. The remainder of it goes pretty evenly split here between enterprise and SMB. This construction volume, remember, we don't charge by consumption, but we break up our customers based on their own size. And so if you're an enterprise, even if you're going to buy a small deal from us at first, we're going to treat you like an enterprise because we understand the journey we go through to build these customers and get them bigger and bigger. And the fun reveal on this one, our business is pretty diversified. You look at the break of ARR, and you'll find today that the enterprise actually makes up over 50% of that ARR. Mid-market, healthy 30%. And the SMB is an area that we continue to invest. We continue to believe will become a bigger piece of this pie. But as I've talked about with some of you, the efforts around product-led growth, e-commerce, freemium, fintech, monetizing the collaborator via PCN, these are all initiatives that are super early days for us, will have a huge impact on the SMB. But what probably gives me the most excitement from this is those growth rates. What you'll see is all of these segments are growing really nicely. This is a diversified business where we are seeing the benefits of the investments we're making across all of our stakeholders, across all of our segments. And we're starting to see particular success in that enterprise. This is a metric we've disclosed in the past. 100K plus customers, million plus customers. Two big takeaways I want you to see: growing. These continue to grow meaningfully quickly. This is a segment that hits the pains first. They have the biggest jobs, the most complexity. Believe it or not, they tend to actually have an IT department, and they're able to implement software. And Procore has become the standard. The other thing I want you to take from this is the diversity of this mix. Similar to the diversity in stakeholders in general, what you'll find here is we have customers across GCs, subs, owners that are all really big. And that we've proven at this point that we can sell to the smallest of these customers, and we can sell to the largest of these customers. And we're still super early days in the penetration of the enterprise and the SMB, and remain incredibly excited about all the opportunities we have with our stakeholders and with our segments. So now I'm going to go on to the fourth vector, geography. Similarly, seems like I've got the similar story to keep coming back to here. 2016, 2017, when I joined, we were only in the United States. We were getting inbound, we had interest in international markets, but we had spent 15 years or so really making sure that we had built the platform, that we understood the product vision, that we could connect and service these different stakeholders, so that, as Tui likes to say, we could take the show on the road. And that's exactly what we did. If you remember my comment at the beginning of this around the longer a product's been in market, the bigger that segment is, geography will follow that same premise. So what you'll see here is we started in Australia and Canada. It was where we had the biggest pull, and it was an area that we felt customers were ready for what we had to offer. So we went to Australia and Canada, and then we focused on a deliberate strategy going forward. Let's start with a beachhead in Europe. That was the UK. Then let's build around it. Today we've got presences in the Middle East, Southeast Asia, several parts of Europe, and Latin America. We are ready for what is to come. Now, what's interesting from this slide, and something that I don't know you all know, is just how much of our how much of our sales and marketing we put in international today. Now, this has been deliberate, and this has been focused. So I talked about that journey of going to multiple countries in these regions, to being in a place where we could build out and serve the broader spectrum, some of the biggest economies in the world. It was expensive. And it takes years for these things to start showing that production. This is building out a leadership team, a go-to-market motion, a marketing presence, a pipeline, getting those early reference customers. As I said, years. Now, what's exciting for us, when we talk about operation margin improvement, this is an area you will start to see it. Because our success in international will mean these two lines continue to converge. And that's where we believe strongly that the market opportunity ahead of us is massive, and it's something I'll touch on in a little bit. Before I go there, let's dive into how our ARR sits internationally. What is that mix? Imagine again, for some of you, you would have thought Europe is the biggest piece of this pie. And the reality of it is not. It's Australia, New Zealand, it's Canada. And you know why it's Australia, New Zealand, and Canada? Because that's where we started. Europe, it's a lot of the United Kingdom. And it's because that was that focus. That's where we've had the years to truly build up that business. So as we start to look forward, not only should you expect that 85% to shrink, but you should expect that pie to continue to become more and more diversified. Because we've built the teams. We've stood up the go-to-market motion. Now we just got to go through the journey of actually building that revenue base. And we couldn't feel better about that medium and long-term opportunity there. We all know we've got some growing pains to do. We are working on those, and we feel good that we understand the challenge ahead of us and that the opportunity is no less exciting than it's ever been. So now that I've walked through these four different vectors, I want to take a step back, talk about why we made these investments. Why did we spend these dollars? Why did I lose my hairline for it? It's because it's such a massive market opportunity. What this slide you should take from is, when you look at the different regions we serve, the primary countries we sell, we say primary because we get a lot of inbounds, we see a lot of deals, but those aren't the markets that we directly go after, so we'll take those deals, but we won't count them in this $9 trillion. And the other thing I want you to take is this concept we've talked about, this triple TAM. What it really means is, while Tui talks about that $11 trillion industry, that doesn't actually account for the fact that when we sell our product to the owner, the general contractor, and the subcontractor, that we effectively get to monetize that dollar of construction. We say 3 times, everyone's got some margin, 2.5. And what that means is we are looking at an opportunity that's over $9 trillion in annual construction volume, of which the US is actually a smaller piece today than international, and international doesn't account for so many different regions that we're not in today. And so we're in the early innings, and we've got a lot of market penetration ahead of us. So we've talked about this. We think that in general, we're still in the early innings. We've gotten a lot of questions over the years. How tapped are we in general contractors? Is that not the market that makes up most of your revenue? Hopefully you've seen along this journey that we've already made meaningful strides in diversifying away from the general contractor being our primary driver. But what it means is, in the US, less than 2% logo capture, less than 14% of the volume. And when we just zoom into the GC, it's less than 25%. And this is in a vertical where we believe strongly that 50, 75, maybe even 85 to 90% of this market is attainable by a winner-take-most market. So we think that GC is just getting started. And let me always remind you, this is just construction volume. This doesn't account for that 50% I talked about in terms of the ability to expand the products and sell more and get more wallet share. Internationally, it's even more compelling. Less than 1% of the logos, less than 2% of the volume. This is why we've invested so much in these regions. This is why we believe so strongly in the ability for Procore to continue to be a consistent, durable grower. And this growth is going to come from both expansion and new logo. I swear we ran this number like 5 times. We did not believe that it was truly 50-50. It is probably not going to be 50-50 in perfectness forever, but it should be close. Because as we've talked about throughout this journey, tons of new logos, tons of new markets, but also a lot of product, a lot of demand from the existing customers, and a lot of growth with those existing customers just on their own business. And so this is for us an indication of the health, not only our existing book, but in the demand that continues to exist out there in the market. And as we think about that expansion profile, what we wanted to do is go through a couple stories here. I think you all believe that we can make GCs into bigger customers. But I don't know if all of you understand exactly what that journey looks like. This is a customer that's been with us for several years, and they started low single-digit 6 figures. In that journey, they more than doubled the number of products they bought, adding BIM, adding analytics, and also growing with us from a volume perspective. But today, this customer pays us nearly $3 million a year in ARR. And the reality is there are many, many more GCs that look like this customer in years 1 and 2. And we're just starting in that journey. We can do it with owners. We can do it with all of our stakeholders, frankly. This example is another one. These folks build data centers. They started with us with project management in a very low sub-6-figure contract. Over the course of several years, we not only took them to 9 products, really getting them to appreciate the broad breadth of everything we have built, but we also were able to grow and take more and more of their book of business. That today, this customer pays us $2 million. And similar to the GC, we have many of the owners, many of the subs that look like this customer in year 1. And we're just getting started. It's why we believe so much in that potential to continue to expand. So with that, let's talk about a metric that I get questions pretty much every quarter, net retention. As we've shown you, expansions continue to do really well. And what that's yielded is that the number you all saw in the IPO, the S1, is the lowest net retention we've ever had. Since then, we've seen it come back to a really healthy 116, something we're really proud of. And the reality of it, it's still not a key metric for us. And I'll talk a little bit more about these pooled model ideas in an upcoming slide. But this number is understated. This number actually doesn't reflect the full expansion we see from our customers because our industry is unique in how they consume. And our flexibility and partnership has led us to a model, pooled volume, that actually means we don't get to capture in this metric the full value of our expansion. I won't spend too much time on the gross retention, except to say what I hope you take from this is we are mission critical to our customers. Because this number hasn't really moved in the 5 years we're showing here, and there was a global pandemic in the middle of it. This is the way of saying that our customers need Procore. It's the last thing they can shut off before they shut off their own business. So as we've talked about a bit retention, I want to take a step back and do a little work on our business model, on why we talk a lot about CRPO and the value of RPO as it comes to thinking through how our business model works. So there's a couple examples on this slide. And what you'll see on the front or at the top is a representative example of a 1-year contract. And what you'll see is over the course of that year, they actually don't deploy their construction volume consistently. In fact, they spend about, in this example, 85% of their overall volume in the back half of the year. But from a revenue recognition standpoint, we recognize it equally across every quarter. In fact, we recognize revenue ratably daily across the course of the contract. We do not recognize revenue based on consumption. And this is even more evident when you start thinking about multi-years. Regardless of which of these customers you look at, the way they consume their volume, it doesn't change the durability of our revenue model. It doesn't change how we consume or how we recognize revenue. Now, I do want to call out, as I just said, that pooled model and how it impacts our business. Think about that middle example. For a large enterprise customer, that's actually not an atypical ramp. They come on, bring maybe 1/10 of the book of their business on to start, and then they ramp from there. But what we lose in that is that 10% to 70%, it's a 7x growth in terms of consumption or the actual use of construction volume. We see none of that in that expansion. And that's why these pool models are really valuable for our customer, because it lets them ramp in an appropriate manner. It lets them have flexibility in really long projects that might span years. And for us, it's important we partner with that customer, that we meet them where they are. And that's why net retention will always be understated, but it doesn't mean expansion is not a huge driver of our business. And it's also why, when you think about how we recognize that revenue, that RPO truly is your best friend. It is the metric that is going to consistently show you what the predictor of revenue will look like. And so to hit on that a little bit further, the other way we get asked this question is what external indicators do we look at, right? How should you all think about the potential for our future revenue growth? And these are 5 of the biggest. We look at all of them. We think they're all important. They tell you different things about the health of the industry at different stages along the way. But they're pretty lumpy. And frankly, they're not nearly as good of a correlation as RPO is. So when you ask us, hey, how should we think about your guide? How should we think about your future revenue potential? And we tell you that RPO is going to be the best metric, this is our proof. This is the best way we could reflect it back to you to say that these industry indicators matter. But our actual RPO guide, or sorry, not guide, but report, is more accurate. So with that, let's talk a little bit about unit economics. What you see here at that 9x is the overall LTV to CAC of Procore. We're quite proud of it. But what you also see here is, remember how I talked about that big ramp up investment in international and the fact that it takes years for that spend to really start to produce the revenue that we expect to come with it. That means over time, we think that international is going to continue to look more and more like the US. And that is going to be a huge driver for us in terms of the potential of showing improving efficiency and economics. But what's not captured on this slide is that 11x is something we also think has a ton of potential and to some degree some understatement. Because that 11x doesn't take into account that we are able to really lean in on that SMB motion. To think about product-led growth, e-commerce, fintech, these are all things that will take the lowest part of the CAC in our business that brings that 11x down and elevate it further and further. This 11x also doesn't account for net expansion, growing with our customers, all of the things we talked about where we're going to be able to get more and more wallet share from our customer. So we think there's just tremendous potential in that overall 9x across both of these spectrums and will be one of the drivers of why we think sales and marketing efficiency is only going to get better. But we're not here to just talk about sales and marketing efficiency. We think we've got opportunity across the entire profile of the business. And what's important from this slide is we've talked a lot over the years, and particularly for those of you who haven't been following us as long, that since we went public, we've been playing catch up from an investment perspective. And that's because if you look at this slide in its totality, what you'll see is that in 2019, the business was growing quickly, but we had a negative 21% operating margin. And then COVID hit. And what's actually helpful to know here is that when COVID hit, we knew what we needed to do. We were able to manage our spend and bring 20 points of efficiency in a year. What you all should take from this is the business model is incredibly resilient. If we need to show massive gains, we can, and we've shown you we can. But what you should also take from this is over the course of this time, even as we made all of those investments we talked about, even as we did acquisitions, we've been able to show a consistent 350 basis points across the time. Now, it's not consistent year over year, but the idea is over the course of time, you should expect that we're able to drive 300 to 400 basis points of operating efficiency year over year, and that will start going forward. So it might not happen every year in a consistent fashion, but that's the right trend line. And what's even more exciting for us is that trend line gets mirrored when we think about free cash flow. So you should expect from a free cash flow perspective, a similar, if not actually slightly better improvement over the coming years from this trend line. What that means for us is free cash flow per share is only going to keep getting better. And it's something that we believe we can drive this in multiple environments. Whether it's strong or weak, what you should know from us is that when we look at our margin profile, we're mindful of those unit economics and we're mindful of growth. And if the environment does change on us, you should expect us to behave in a way that drives increasing operating efficiency like we've done in COVID. Because we believe that this business has so much potential that, as Tooey coined in our last earnings call, we've got efficient growth on our minds. And so if I take a step back and I try to summarize this all together, we're in the early days of building value creation. We built an amazing business with general contractors, and it's still early. Product-wise, logo-wise, everything we talked about, it's huge. But then we added specialty contractors. We built on this opportunity. We added owners, another vector of just amazing TAM and growth potential for us. We did all this while taking the show on the road. And as we look at these vectors, these building blocks, what we believe is all of them are a TAM multiplier. There's tremendous logo potential. We can expand volume. We can drive more products. We can generate network effects, all while improving unit economics along the way. And by doing this, by entering these markets, by building this brand, this customer base, this network, it's given us a right to play in a whole new league, fintech. This is something that's very early days for us, but it's something that we believe core to our mission is critical to improving the lives of everyone in construction. Now, if we do this right, our customers will not only love us for it, but we'll be able to drive meaningful growth from a shareholder perspective. So as we look at this, We think these building blocks not only drive more and more customer value, but we hope you all agree with us they will drive more and more shareholder value along the way. So with that, I get to hand it back to Tui to talk about the next chapter.